All right. Another live. Josh and I are having internet issues. So if you are watching on video, might be we might reset I go a different direction. No, this we are back. So yes, credit was there. Uh, okay. All right. Josh was on. We're gonna figure it together. Okay, we no, let's go. All right, Josh, no. Hold on. The large margin risk studies. I'm only looking just to let you still hear I am not sure what is on.
You're in with the wired connection. Go. I'll be back.
I guess. I don't know. Can you guys hear this crap? Are you guys as frustrated as me? Yeah, who knew? Best comment of the night. Somebody said we all knew something was going to crash. Little did we know it was actually going to be the internet.
The show.
Yeah, the show crashed. Oh, God. Are we here? Are we actually live? Oh, my goodness. Guys, welcome. Holy shit. We just lost 7 minutes of the show. We'll go 7 minutes longer tonight, Josh. For the podcast, we'll actually cut this out. So you guys have what's going on.
I like that idea. Never happened.
All right, guys, here's what we're going to do. We have clearly wasted a lot of time, but nevertheless, so I started the show by saying, downgraded. So the U.S.'s credit rating downgraded today, caused some volatility in the bond market this morning. We got mortgage applications. Mortgage demand is down. Rates are kind of bouncing all over the place. What else do we got, Josh? None of it is great news other than basically price stability somewhat in the market. Inventory remains low. We'll take a look at some charts. Outside of that, Josh, anything you want to jump into before we dive into charts?
No, we'll go through some charts and data, and I wanted to bounce some stuff off of you for the benefit of the viewers. So yeah, let's just jump into it.
All right, here we go. So this is where we always start each week. And I'm going to preface this by saying I cut out a couple charts, and just to make it shorter, trying to get through this stuff, I'm going to put a survey up in a minute. Had it all prepared before the world fell apart with the internet connection. But nevertheless, I want to get your thoughts on the direction of the show. What do you guys think? All of that good stuff. Nevertheless, inventory overall, I think we added, 5,000-6,000 homes week over week. We're now sitting at 484. We'll see it in the week landscape, but more or less inventory not doing much on a nationwide basis. Orange County, we're up a little bit, 23.99. Huntington Beach sitting at 196. Again, if you're watching this on YouTube, in the description, there'll be a link to these slides. If you're on audio, you're listening on the podcast, we'll have a link for that description in the description of the email, so you can check it out. New listings. The reason we're not adding inventory, no new listings are really coming to the market, more or less staying flat, and it has been for the last 4 to 5 weeks. And that's why inventory is dismal. Weekly, what did we add? We added, we went from 479, 273 to 484, 599. So about 5,000 homes. Inventory last year, this time we were sitting at 538. So considerably higher than where we are today. Again, these are charts we go over. I'm just going to skip over these. They're not really telling a big story. If you want to see them, they are in the description. Percent of properties doing some sort of price reduction. We're seeing that continue to go up. It looks like it's probably going to continue that trend for the next couple of months. Those people that want to get their homes sold that are on the market, they're not moving. They're going to have to do something differently. Josh, we actually talked about this. You sent me an article. So this was a survey done, I believe through, was it Zillow that did the survey?
Yep.
And basically just, it was a survey out to consumers that own homes. And the question was basically, at what rate would you start considering transitioning out of your current mortgage? And it looked to be 5%. So this chart doesn't really tell the whole story, but basically 5% was kind of the rate where people would start to make a move. Josh, where are we at on the 10-year?
Well, Jeb, I think if you go back, I think what it's showing you is mortgage holders with rates higher than 5% are twice as likely to sell as those with rates below 5%. So saying again, if you have a 3% rate, only 21% say they might be likely to sell. If you have a rate over 5%, it's double that rate because you're not giving up that much. It's just what you're having to give up to enter the market right now. Anyone who says there is no lock-in is not involved in the market and not checking things out, because that exactly jives with what we're seeing on a day-to-day basis. I don't think we talked about it in the show last week, Jeb, but I told you that I'm not talking to hardly any move-up buyers. They are almost all first-time buyers or a buyer who's going to keep their home with their 2-3% rate and buy a new home. So those are the people in the market. There's just not a lot of move-up buyers. That's anecdotal. That's me. I don't talk to every borrower in the world, but that's absolutely what I'm seeing.
Why
They
do I
don't
have
all
you
call
on the
me.
show? If
They
you're not
they
talking
don't
to every
all call
borrower,
me,
I don't
Jeb.
want you on the show.
Yeah. Well, my anecdotal experience is limited.
Well, we might have a change next week, guys. I thought Josh talked to every borrower, therefore we had a full detail landscape of or everyone on the landscape, but clearly not. So Josh, what are we looking at here on the 10-year?
So yeah, this chart here just shows us
Sorry, we both clicked it. There you
yeah,
go.
it just shows some support and resistance levels. So we actually hit almost to that 415, the red line over there to the right today. And you see where it's saying is we closed at 409. So some data, market continues to be bearish. Jeb had pointed out to me like 7-8 calendar days ago, he goes, I don't like this chart. This thing's ugly. And you're looking at it and you go, we don't really have support until about 409, 410, 411. And we bumped up, I think 412, 413, almost to that red tick mark today and backed off all the way down to 409. Now, really the best case that we could hope for, if we look here, I'm going to slide it over to the next one. This channel is an up channel. So even if that support holds today at 410, 411, the best we can hope for is to move to that bottom of that range, which is another way of showing you about 389. So our best case scenario is about 20 basis points or less than 0.25% better in interest rate from here. If this gives way, we will make a run up to 425, which is a quarter worse. So in real terms, we're in a bearish channel. Rates are getting higher. So until we break out of that lower white line down there at the bottom, our best case scenario is a quarter better than where we're at today. Our worst case is about a quarter worse. So not a whole lot good on that front. You guys always like to know where rates are. This is one of the services that we use. It aggregates Mortgage News Daily, Freddie Mac, and the MBA. Mortgage News Daily is far and away the best. So they're reporting 7.13 on a 30-year fixed. That's a really hard data point right now, Jeb, to use.
I'm Jeb. Nice to meet you guys.
Not Deb, not Debbie. Because of the loan level price adjustments. It used to be anyone 740 and above was going to get the best terms. Those people didn't have a whole lot of LLPAs. That range, I have one that's going to close Thursday. It's at 7.5. That was the best they could get with like a 698 credit score. Someone talked to today, they've got 800 scores. We can get them a 699. So that is fairly accurate. The 30-year FHA is probably a little bit better than that. 678, they're reporting maybe 6.5. Jumbos, as you're seeing, maybe you guys remember a year ago, jumbos were a big discount from what you were seeing on the 30-year fixed. That space has been hit hard by the banking crisis. Those lenders are not super interested in lending, so they have not been nearly as aggressive on the terms. They are out there, but they're few and far between, and on the average, they're worse. So that gives you an idea of where we're at market-wise today. And again, we are in a bearish channel until that breaks. Be very careful if you're in the market and considering locking an interest rate.
Okay, before we dive into the next chart, I want to ask a question. Put a survey into the chart. A lot of you guys are answering it already. The question, the way I wanted it to be, I'm limited on the number of characters I can type in each one, but essentially asking the question, do you like the way the show flows now? It ends up being about 15, maybe sometimes 20 minutes of charts, which I feel like is a lot. Do you like that? Would you prefer? That's option one. Keep it like it is. The second one is, yeah, we like it, but less charts would be better. Third option is, yeah, we like the charts a lot. Do more of them, but take it to another live, maybe on another channel, maybe the Educated Homebuyer channel. Fourth would be, I hate it all. Just answer questions. Like, I'm here for the Q&A. You guys don't do, you guys aren't great at news summary. Just do your job. So that's floating in there. Answer the questions right now. It's, I don't know if you can see it, Josh, but high probability sitting, keep it like it is. So, that's what Josh thought. I thought we needed to do less of the charts, but either way. So let's take a look at GDP, and growth on the economy. What's happening there? GDP is just great, Josh. I mean, the economy is so good.
All of these charts are going to tell a similar story, and it's fairly depressing. So the top line is GDP, and its growth over time has been decreasing. You see the trend down. Ignore the weird noise on the far right. In the recent past there, went way down during COVID, shot way back up post COVID. And what you'll notice is at the same time, debt levels have been increasing post COVID, skyrocketing. That's telling us that GDP growth is going to continue trending lower in the future. So anyone looking at current charts and saying, hey, the market's great, economy's great, 2.4% GDP. We got an upgraded revision. It was earlier this week or last week, and the market reacted like, whoa, economy's hot. 2.4 is not good. And that was an upside surprise, and we see serious headwinds going forward. So I'll try to go quickly through these. This is basically telling you the same story in a different form. The black line there, GDP going down. The blue bars at the bottom is debt going up. Debt leads to lower growth. And in case you haven't noticed, we have quadrupled the debt in the last 15 years. 8 trillion wasn't good. 32 trillion is awful. This chart, I actually meant to look up the historical number on this of what you could expect for. You talk about the government is going to stimulate. We're going to do stimulus. We're going to pump money into the economy by taking on debt, and that will get us growth. Right now, it takes $4.50 of debt to get $1 of GDP growth. That is, in essence, no longer worth it. So the next time the government decides to stimulate the economy, tell them, please no, because my grandkids are going to have no money left. This shows, again, the orange is just total debt growing over time. The black line there, or the blue, is GDP. The black line says, with that GDP trending up, how much debt is supportable? Well, you may have not noticed there, but the gap between those is a spectacular difference there, and not getting better for us. So this one here, debt, interest expense, GDP, and tax revenue, shows you that all of those, except the federal debt, have been pretty stable. So if your income is increasing at a stable rate and your debt is increasing at an exponentially higher rate, it's going to be problematic.
Are you talking about me personally?
I'm talking about you personally.
Because my income is going down. My debt's not changing, Josh. That's the problem.
Well, I don't know. Did you finance the tires today?
I did not. I paid for them in cash, but
So this one here, Jeb, shows we have not so far seen much of a problem. So debt outstanding and the effective interest rate. So the blue line is debt going to the moon, like we saw in the other charts, but not being a problem because for 40 years, interest rates went down. Interest rates, as you see, that little right tail, orange tail on the right there, is trending up. So unless rates moderate fairly quickly as more and more debt rolls over, it's going to be a problem. Federal interest expense, you can see last year shot up from 600 billion to almost $1 trillion, and we're going to be up to almost 1.2 trillion by the end of next year. That's a problem when your debt service, the money to pay your credit cards and loans, doubles in a 2-year period. I don't care what's happening income wise, that's problematic. So we say, okay, cool, what are we going to cut back on? Where are we going to save? Everything here except that little blue portion. 88% of every tax dollar goes to non-productive spending. Those are not things that are discretionary that will either lead to growth or that we can cut back on. That's Medicare, Social Security, National Defense Budget, other safety net programs, just silly stuff. This here, Jeb, is now a little bit out of date. I believe it's trended up the last few days. The market, for some reason, thinks very marginal data is strongly positive. And I think they've ratcheted up expectations for the potential, not much, but for the potential of a hike. So this tells you the market kind of thinks there's going to be one more hike. And then we are out,
That's counterintuitive to a chart that I saw today, Josh, which shows the probability that it will stay the same. Which I'll find here in a minute if you want to talk, and I'll pop it in there just so we're.
So they're saying that was as of July. The expectation was 5 and an 8. So we're here between July and August. So 5.33, and they see it peaking at 5.44. So there's a marginal chance that they see another hike. Are you saying the data that you have, Jeb, is not accounting for a probability of one more hike?
Correct. Yeah. What I have is us staying here. Basically, the probability shows that September meeting, there's an 82% chance that we're at the same rate now.
Yep.
And that 82% is the highest over the next 5 months. I mean, it drops to 66%. I'll put the chart up here in just a sec after we get through.
Well, 82% of nothing happening. So there's an 18% chance that something happens, and then a 34% chance at the next. So that jives with this, because this
just the probability is higher that it stays than it goes anywhere else. How's that?
At each individual meeting in aggregate, it's less so than that.
Yep.
So just looking here, that is what the market's saying. Like Jeb and I had a conversation earlier this week that I just went in and said, Jeb, what am I missing? Like none of this data is good. It's mediocre to slightly bad. The market is truly looking for two things right now: out and out negative, bad economic data and weakening employment situation. And we're just not getting any of that data. We saw today ADP last month, they came out with a crazy number, 500 something thousand jobs created, or almost 500,000. Market went nuts. And then the non-farm payrolls came out on Friday, 2 days later, and said, no, that's not really happening. Saw another blockbuster number today. The market ignored it and saying, show me the real numbers on Friday. So we'll see Friday where we go from there.
And at the same time, still got job openings sitting at 9.582. So 9,582,000. It was predicted to be a little bit higher. As that number goes down, or if that number continues to go down, that is a sign that, essentially the economy is slowing, and more of a reason that the Fed might decide to do something different than they've done the past 18 months or so. So again, you've got non-farm payrolls, not non-farm payrolls tomorrow. You got jobless claims tomorrow, and you got payrolls on Friday. So between those two, you could see the market move in one direction or another. If jobless claims comes in strong tomorrow, it's something the market's been paying a lot of attention to. It may not move as much tomorrow just because you have the actual BLS numbers on Friday. But either way, strong jobs reports are not good for data, and in turn, not good for interest rates. And Josh,
what I would love to see on that chart there, Jeb, is what population growth overlaid there. What should it look like? Because if we just make a linear trend back there from the end of 2008, when there was like 2.5 million job openings, if you get to COVID, it is sort of stagnated pre-COVID to about 7.5 million. And now we're sitting here, 4 years later at 9.5. It's still elevated. We've talked about this before.
Yeah.
We've talked about this before, that with the population trends of an aging population, more people retiring, that there's likely to be less people to fill jobs. So that number should trend up. The only explanation I've heard that makes sense that this might be overstated, or this problem might be overstated, the strength in the jobs market, is the idea that now, with a lot of jobs being remote, they'll be posted in multiple areas. A single job can be posted 2, 3, 4 times. So you see these job openings not really being a single job, but one job posted multiple times. But we'll see. Let's flash forward a year, and the data will tell the story.
No, it's interesting that if you did draw a trend line from 2008, towards the top bottom, that's where that we're sitting now. It's pretty much in a channel there. If you take out COVID, it's interesting. I'll have to do that. We'll show it next week. Last chart, you guys are, often asking about, and we're seeing any buy downs in the market, or sellers giving credits. We'll talk about a property I listed later in the show this past week and what happened there. But, this shows you prior to last year, October last year, when rates peaked, you had a lot of people doing buy downs, right? Trying to get the rate down. Since then, that number's come down considerably with the number of people. It's almost like people have adjusted to what's happening out there in the market with rates. And therefore, the credits have backed off. Sellers also know that they're not really having to do this stuff in a lot of markets. Therefore, there's just less of it out there taking place. So hopefully you guys provide some value or see some value in this stuff. At the moment, we have 47 votes, Josh. We're sitting at 81%. There's 11 people that believe it could be shorter, but what I'm confused by is there's 120 people watching this. So there's literally 72 people that haven't voted. They don't care. And there's only 32 people who have liked the video. So I'm going to take some time here and ask a question. One, if you're watching this, vote, please. It takes 2 seconds. It doesn't change anything. Just make a vote. We don't know who voted what, right? There's no calling you out at the end of the show. Secondly, if you're watching this and you're one of those people that voted, at least hit the thumbs up, right? You could have hit that thumbs up and we'd be up at the same number of votes. And or if you haven't voted, vote, right? It helps. It helps the trend. It helps the algorithm. It helps all of that. And it helps us. It supports the goal here, which is educating home buyers. So that said, if you need more information on becoming an educated home buyer, you like long form videos, you like Josh and I just talking back and forth versus a talking head, which is my channel primarily, go over to The Educated Home Buyer, subscribe to that, listen to the podcast. This past week, we talk about the biggest mistakes that we've made, that I've made as a home buyer, as a seller in owning real estate and buying real estate. So listen to it. Let us know what you think. This next week, we're talking about our buddy Dave Ramsey and his methods and what we agree with and what we don't. So that'll be next Tuesday. So check that out. In the meantime, if you need to get in touch with Josh, you need a mortgage professional, there's a link that's going to be scrolling the bottom here in just a minute. If you're in my market, you need a realtor anywhere in the country, reach out. Would love the opportunity to guide you through the process, refer you to somebody I know, like, and trust. So somebody pointed out to me today, they were like, you should really stress the idea that when you're making a referral, Jeb, you're making it to somebody you know, that you're not just a website that when something comes in, you're just sending it out there. Like a lot of people are with Homes and what the hell? Homes and Money and Homes and Money, where you fill out your information. They don't know who gets the lead. I'm sending you to somebody I know that's going to take good care of you. Use that. Nobody else is doing that. It takes time for me to do this. Use the network. Let me get you in touch with somebody who can help you. Same as the mortgage side. I'm not just sending you to some random person. I know who you're talking to. That's important, guys. Anyway, I'll get off my soapbox.
No. You can be on your soapbox, because what I will say, got an offer accepted earlier this week. That buyer came in way late. We talked to him 6-8 weeks ago. I didn't know he had been connected with one of Jeb's agents, and it's a guy out in Lancaster. That's awesome. What I can say is
awesome. I have closed like 5 deals.
Yeah, I have never had a bad experience with an agent that Jeb referred a buyer to, that we also did the loan. And that's uncommon. You already know it's 80-20 industry, 20% are good at best, and we're batting 100 with Jeb's referrals.
Yeah, and not everybody's going to end up buying a home. They're not going to find what they like. I mean, there's a lot of things going on there. So, Josh, before the show ends, remind me to talk about a property I listed. Multiple offers. In fact, I had multiple viewers who watched the show come into the open house and be like, dude, I watch your channel. I'm like, I'm never comfortable having that conversation, but a lot of people will watch the channel, find value, whether it's my videos or the lives or whatever. So thank you guys for the support. All right, Josh, we got some questions here.
We have a very important question that's been asked multiple times. Where's the poll? Where do you vote? Dina doesn't see it.
At the top.
So
it's at
the top of what?
At the top of the chat there. So if you go to the top of the chat, it's a little blue box. At least that's what I see on my side. If you're on mobile, it might look a little bit different. For you guys who are on desktop, let them know what you see. I got 2 screens going. So I've got the screen that we're going live with, and I also have the screen where I see the poll. So 56 people have voted, 55 likes now. So we're kind of like, we're trending there, guys. Good stuff. But if you can't find it in a minute, let us know. All right. Let's see, Josh. Let's start with the downgrade question. So we got a lot of it, actually. So we're going to click through a couple of questions, and then we'll address the question. How's that? With the U.S. credit downgrade that just happened, what impact, if any, does that do to mortgage rates, the spread between 10-year bonds and the 30-year mortgage? And then we have S&N Media coming in. Fitch just downgraded the U.S. credit. This is the second time in history that U.S. credit has been downgraded. How impactful will this be to the economy and housing? And I think that's the only ones on the credit. So Josh, let's talk on that. So there were some very prominent figures in the banking industry and whatever, Jamie Dimon. I'm drawing a blank with names at the moment, but people basically came out and said it wasn't good that they did it, but at the end of the day, it doesn't really matter. So, we didn't really see a lot happen in the bond market per se at the end of the day. Maybe some initial reaction, but what are your thoughts on that, Josh? What is, what's being paid attention to?
So the timing of it, the only reason why they would have done it today versus say when we were having the debt ceiling debate 6-8 weeks ago is the quarterly refunding numbers. At the beginning of the quarter, the Treasury announces, here's how many treasuries we are going to sell to finance the debt. How you guys did not pay enough taxes for us to pay our bills. Here's how much we're going to borrow to pay the bills going forward.
I paid my taxes.
You didn't pay enough.
And I feel like I paid enough.
They cannot pay their bills. So from there, what you're seeing is the market did not like that. So I believe that's really why the timing of the downgrade today. I think it's symbolic. It's basically saying, hey, cut this out. Politicians, and for those of you that are partisan political followers at home, whether you're watching MSNBC or Fox News, you're all wrong. All politicians are morons, and they all want to spend too much money because they know by the time they're out of office, it's someone else's problem. So our politicians of all stripes, whoever we have managed to elect, needs to figure this out, that you can't just keep borrowing money without increasing receipts, which that's basically taxing us, which I don't think any of us want either. But there's going to be a combination of both. They're going to have to cut back spending, and they're going to have to increase taxes. There's no other way around it. You saw those charts. It is unsustainable. So I think the move today of rates being worse, you saw it was really bad in the morning and kind of technical bounce in the afternoon because there was no news that came in that led to that improvement from 411 to 409 or whatever on the 10-year. But I don't think it was a big deal. But the idea of too much debt and the way the market reacts to it is a big deal.
No, agreed. Yeah, good stuff. And so Josh's wife just texted me on the thing and showed me where it looks on mobile, and it looks like if you're on the live chat, if you're in the chat there, it just pops up. So you should be able to see it if you're looking to take that poll. It would be helpful. There's 63 votes. I mean, it looks like regardless at this point, the majority are saying keep it the way it is. But everybody counts here on the Educated Homebuyer Live. So we would like you to put your vote in and let us know. All right, Josh, we got a super chat. $20 from Andrew Kuhn says, love the video, guys. I'm an agent in Nashville and enjoy hearing the overall market news. Cheers. So cheers. Andrew put his money where his mouth is. And so for that, we are thankful. Appreciate you watching and following along. I know we got a couple of agents in here. So, but he also goes say, love the charts. I'm not in California market, but still get a lot out of the macro news. So helpful. So you guys win. We will continue to do what we do here. AB has a question. AB hasn't been on here in a long time. It says, Jeb and Josh, hello, bros. Thoughts on getting solar for the house? Worth it? Problems trying to sell a house with solar panels. So if you guys have been around for any period of time, Josh and I have pretty much been on the same page with the idea that we believe solar, somewhat of a scam. That said, my opinion is starting to change a little bit. Things can change over time. My opinion is one of them here on the show. And I'm pretty transparent when things change, and I have no problem admitting it. And so the reason I'm starting to admit it is because I'm starting to see it personally with electric car and other expenses sending my bill up. Now, the reason I've always said in the past that I didn't agree with it is because I would see people that would have $200 to $300 bills, with electricity and everything, and the solar was $200 to $300. And I'm like, you're getting no benefit here. Yeah, at some point the solar panels will be paid off 30 plus years later. At which point, maybe your cost has gone up on energy and maybe you're saving a little bit, but at some point those panels are going to need maintenance. They're going to need replacing. They're going to need cleaning. There's other expenses you're not factoring in there. So the real savings is minimal. Now, I always said with that, if you live in an area where you're heating a pool, your air conditioning is running all the time, that makes sense in a lot of those markets. Now, here in Southern California, we don't run the air all the time. I don't have a pool, but now that I have an electric car and I've got other things going, it's getting to the point where solar panels could start to make sense. I just think there's too many unknowns with it. There's too many bad salespeople out there pushing a product that they don't truly even know the ins and outs about, quite frankly, because we don't know the long-term deal with how some of these solar panels are going to last, what the maintenance, replacing, all of this stuff, and that becomes an issue. But to answer your question, if you're gonna get them, buy them. Leasing them sucks for the person that buys your house. That's when it becomes a problem. If you have leased panels and somebody buys your house, they got to take over the lease. They have to want solar panels. They have to be okay with all of that. So if you're going to buy it, in my opinion, if you're going to do solar panels, buy them. That was a long-winded answer, Josh, but what are your thoughts?
So I threw up in the comments a tool that I love. Start your research here. Do not start by calling someone, asking them if someone sells solar, they're going to tell you why it's amazing. It's sunroof.withgoogle.com. So Google allows you to plug in your address. It looks at your house or the house you're considering buying, shows which direction it's facing, what size of installation you can put in. And it works better if you already own the home. Because for me, I was able to go back and take my last 24 months of utility bills and go, here's how much over a 24 months, what I pay every month. And it actually was starting to get close enough that I would consider it. Now, again, Jeb and I live in Huntington Beach. We get coastal breezes. There's about 60 days out of the year when we like to use our AC. The rest of the year, it is not even thought of using. So my place out in Rancho Mirage, there's maybe like 60 days out of the year when you don't have it on, if that. So this takes all that into account. Is your roof situated for it? And then it also breaks down. It's like, Jeb, you said don't lease. Definitely agree that it can be problematic or an issue for your buyer, but this shows you power purchase plan, lease, own, what those three look like, and you can figure out what the break even is and when it makes sense for you. Like for me, I'm still of the position that I want to put it off. I need a new roof 4 or 5 years from now. And I'm hoping to do a solar roof where it's all tied in one, where I don't have these ugly panels on my roof. I don't want my house to look like shit because I wanted to have some cheap energy.
Well, and that's what you got to factor in, right? So you're just assuming the cost of the panels. Now, a lot of these agreements that I've read say that they'll remove them once for you to redo your roof, right? So they'll come, they'll pick them up, they'll move them, and you can do your roof, and then they'll put them back. For one, that company's got to be in business that agrees to it. So there's just things that you have to factor in. If your roof's brand new, okay, probably not a big deal. I just think too many people look at it, get caught up in the idea that just like an electric car, like I'm not going to have gas. It's going to be so much savings. Guys, I'll be the first to tell you, having an electric car isn't saving me any money. My insurance is expensive. The tires are more expensive. You go through them more because the torque on the car goes through the tire. I mean, there's just so many things that it is not broken down in the big picture. So do your homework before you do it. And to answer back to Dina, I'm not considering solar panels. I'm becoming a little bit more open to the idea for the right people. How's that? All right,
Jeb, I want to ask a question because Eric followed up, says here in Texas, solar panels are bad because as soon as a hurricane comes through or a tornado, the first thing that blows off is the solar panels. Eric, do you or does anyone else know what happens? Whose responsibility is it? Homeowner's insurance? If it's leased, is it the owner of the panels? If anyone knows, feel free to comment.
No, good stuff. All right, so we got some other questions here. So I saw one on. Let's go with this is help. So
I promised this person we would answer the question. So I'm glad you got to it.
So my escrow company undercharged me for the property taxes for the last 2 years. Now they are adding the difference to my monthly payment, up 50%, causing me to struggle making the payment. So Josh, is this normal?
So it's
2 years is a long time, but
it's super not normal because they are required to do an annual review. So I want to know how it got to 2 years. I would ask them, did you do a review last year? How was this not caught? How was there that big of a change? So for those of you outside of California, you're tired of hearing us talk about Prop 13. Our property taxes can only go up 2% a year. I know in other parts of the country over the last 2 years, when home values went up 15, 20% a year, your tax bill went up 15, 20% a year. That's how this happens. But that's the reason why that account is supposed to be reviewed and brought up to date at least once a year. They don't want to cause you problems. They don't want to foreclose on you. I would ask the question, is it possible to spread that over a longer timeline? But I would also absolutely ask, why did this go 2 years without being caught? Was it 2 years? Did you have a reassessment like that was retroactive back 2 years? I know every state does a little bit differently, but those are the questions that I would be asking. You owe it. Your property taxes are your responsibility. So there's no way around that. They are just a middleman, and they have every right to account for it and get that collected. And if you really want to know the details, go back through your loan documents from when you originally signed, and it's all there in legalese. People always ask, why are my loan docs 100 pages when I really only care about my closing disclosure, my note, and my deed of trust? This is why. They cover everything in there, so you cannot come back and sue them, much like a builder's purchase agreement.
I mean, no different than when you buy a home. Like my client called me this morning. We went into escrow on a property, and she goes, the disclosures are 80 pages. I'm like, well, they're mostly boilerplated in the ones that you're looking at, but it's because somebody had a problem at some point, and now there are documents there to protect the buyer, the seller, the broker, whoever's involved, so that none of this can come back, right? You are supposed to read every word of those 80 documents, and there are people that do, but
Jeb,
the majority do not.
I think this is helpful to anyone watching. If you're buying a home, they refunded me for 2021 and lowered my payment. Then for 2022, then 2023, they charged me the difference and increased the actual due. We had one of the biggest lenders in the country that we put a bunch of loans through. They were famous for once a year they did their impound account reviews. And if we closed a loan in February and their schedule was they review everyone in April, 2 months later, they'd go through and go, you guys are collecting way too much. They'd give it back and they'd drop the payment. And then at 12 months forward in the future, we would have a problem like this. So when you have, and Charles Boswell just says, what is escrow? It's an escrow impound account. It's not the escrow that handles your closing at settlement. It's an escrow impound account where you pay extra every month in your payment, and the lender collects for your taxes and your homeowner's insurance and pays for it when it comes due.
It can be called impounds too. Yeah.
It could lead to these issues. But if you get a review and you have it reviewed in the first 12 months, reach out and they reduce it, reach out to your loan officer that did the loan for you, and hopefully they understand these better, because the people that handle this at the lenders, I guarantee you, they are entry-level clerical people. It's a rule. The computer says do this. Here, I'm doing it. So reach out to a lender, the person that you did your loan with, and hopefully they can walk you through it and say, yes, this is right, your payment is lower, or no, I gave you the right payment. Please either have them raise it or continue saving the money on the reduction.
Good stuff. Kel just said her escrow went up $900 a month. Yikes. Kel, I want to know where you are.
It's a lot.
Let us know in the comments.
What's the assessed value on your home too?
Yeah. Where? Yeah, exactly. Like where are you, and how much is your home worth? Okay. Let's do this. A lot of good comments. I mean, you guys seem to find value in what we're doing. I mean, 83% of you out of 76 votes, are saying that you like the format. So the format will stay the same. And we'll continue to do charts for the first 15 minutes or so to kind of bring you guys current on the market. My whole thought was, like, the data doesn't change that much week over week. So is it boring? Is it too repetitive where we're missing your questions because we're talking too much? So anyway, here's no. Is it worth doing a buy down or putting more money into the down payment? So Josh, how much does a little bit more money affect your monthly payment? I guess
not much. So let's say you're buying let's use a real example. Watcher of the show reached out to Jeb. Jeb connected with me. They're buying a cool house up in Coeur d'Alene, Idaho, and they wanted a payment at a certain amount. And so it was going to require 10% down, and that was going to get them a $3,400 monthly payment. And we looked at it and they're like, I don't know if we want to use all of our money. So we look at it to only put 5% down. So 5% of a 525 purchase, like $26,000. It was $146 on the monthly payment. So it's about $7 plus or minus per thousand. So most people are highly disappointed by how little their payment drops. So if you're trying to manipulate a payment, every dollar is going to reduce that payment more with a buy down. We've talked on the show here why I don't love buy downs either way, whether it's paying points for a permanent buy down or a temporary buy down. My preference would be for a temporary buy down, because if and when in the first 2 years or 3 years of that buy down period, you get a refinance opportunity, any of those funds not used, you get to benefit from. but it's temporary. Eventually, you're going to end up with the market interest rate. Now, on a permanent buy down, the benefit is I'm going to benefit for as long as I have this loan. Again, going back to the charts we start the top of the show with, I still believe 2 years from now, we're going to have lower interest rates, not 2 or 3%, but probably 5.5. So if you're looking at paying 2 points to go from 7.25 to 6.75 right now, you're going to lose that money because the break even, lenders are very savvy. They don't look at one transaction where you might think I'm going to be here forever, I'm never going to refinance. They look at the entire market and say, we closed 10,000 loans, they're going to pay off in this time frame. So don't love buy downs, but if you need to move that payment lower, permanent buy down, temporary buy down are going to have the biggest impact on your monthly payment, far more than making a larger down.
You know, before I get to the next question, I just want to say Nightbot is by far the best commenter, whatever. So Nightbot is like an AI generated piece that helps do things in the chat. But MTB gave us like love, says give these guys
nice
a like, fam, right? But it puts it all caps. Nightbot comes back and basically says Nightbot 1, bad guy 0. Stop spamming caps. Gives him a warning. Love that. Absolutely love it. I love both. I like MTB's comment.
I like both.
And I like Nightbot's comment.
But Jeb, if Nightbot is going to declare victory, shouldn't he have just booted MTB East from the chat entirely?
I don't know that he has authority. I don't know if I've given Nightbot authority to just, Wesley says it's not AI, it's just code. You're right.
Thanks for being a joy killer, Wesley.
Yeah, just sounded better, Wesley. You know, nobody's talking about code on the internet right now. AI is trending. We were trending there for a moment.
We're going to start calling him Wesley.
Way to steal my thunder, man. I'm 43. I still want to sound relevant. My kid said something this morning. I was like, what did you say? And he's like, he tells me, I forget what the word was. He's like, Dad, it's blah, blah, blah. You need to be up to date on the lingo. I'm like, bro, like, I don't know what just happened, but not cool. That's all I'm saying. Hopefully he's watching right now. He can comment.
Jeb, I've been triggered, so I want to comment on a comment. It's actually a mild trigger. Mermaid Tiva says, "Oi, we have a 2.65 on an FHA, but the PMI is killing me." Here's the reality.
The PMI is killing you.
With a 265 rate. Yeah, with a 265 rate, you have 0.85 mortgage insurance. That's what it was when rates were that low. So you are at 3.5 on your rate. Everyone else in here who doesn't own a home or is buying a home now or looking to refinance would kill for a 3.5% rate. So stop saying, hey, a portion of this is mortgage insurance and I shouldn't have to pay for it, and just accept that you have a 3.5% interest rate. Then you should feel awesome about your loan.
Yeah. Again, cost of doing business. That's what mortgage insurance is. You weren't in a position to get rid of it. It's there. Who cares? You have a rate that a lot of people would die to have at the moment. So,
but Jeb, again, is it cost of doing business or a necessary evil? Which one is it?
You have to watch the episode next weekend to find out. All right, guys, there's 157 of you watching. There's 67 likes. That means there's actually 160 makes the math really simple now. 93 people that haven't taken an action. Take an action. Well, dislike it, like it, share it. Comment, do something that shows that you're not just code out there in the chat, that you're not Nightbot. Nevertheless, appreciate you guys being here. Appreciate the support. I'm at 88,000 subs, guys. Trying to hit 100,000. My kids want to throw me a party. I said, what are we going to do? They said, we're going to go to the trampoline park. And I was like, okay, I guess we're going to the trampoline park. They would choose that regardless of what happened. But no.
I think they're just looking for an excuse for a party. But Jeb, we got a question for you. Ricardo would like to know, for the average Joe, what's a good way of getting an approximate value of my home? I look at what Zillow says and I trust it as much as I trust my politicians.
You know, it's good. I mean, honestly, there's not, and this is going to sound really cliche, right? Because I'm a real estate agent, but call the agent that bought your house. I mean, that helped you buy your house, and ask them, what is my home worth? I do it all the time for clients who reach out, and it takes 5 minutes for me to pull up that information. In some cases I might actually know, because I might know the neighborhood, but I would just say, look at, don't look at Zillow. Look at Zillow. It's a piece of the puzzle. Look at Redfin, a piece of the puzzle. we can look at your tax records here in California and get an idea. It gives us a range, an AVM, and honestly, usually pretty accurate for the most part. But don't just use one over the other. I mean, the real way is to get an appraisal, but even then, I would say just they're going to do the same thing I'm going to do, and I'm going to do it for free. So call an agent, let the agent guide you through the process. That's really the simplest way.
And I will say, like Jeb, the more unique your home is, the less valuable any of the online resources are.
Absolutely.
And valuable a realtor is. But if you're in a unique area that's not densely populated, it can be very hard for a realtor as well. The market will tell you when you throw the for sale sign in your yard if you have a truly unique property.
Agreed 1,000%. Yeah. The more rural you are, the more unique, the more your home is different than what you think your neighbors are, makes it even more of an asset to have somebody that can guide you through that process. Josh, I saw a good question here. This one. Well, let's
go ahead. Good.
It says Chizzy Black says, another question. What's better, continuing renting an apartment and save $8,000 to $8,500 a month? That's a lot. Or buy a dream house and save about $2,500 a month. Help me and my hubby settle this. So my question to you before we answer this is, what does your dream house look like? What purchase price are you? Because I'm trying to figure out appreciation based on how much you're saving, right? So if you're saving $8,000 a month, that's $96,000 a year. Is that right? $96,000 a year, almost $100,000 a year that you're saving. I don't know that you're going to get that kind of appreciation in a house. What are you doing with that money that you're saving? Like, let's have the conversation based off your purchase price. The answer might still be to buy, but it might be, hey, listen, you're in a good position renting. Do you need to buy? I don't know. So
hold on. It's not this simple. $2,500. If you are looking at that, so I'm assuming $6,000 going to the housing payment. So it's a $600,000, $700,000, $800,000 purchase, depending on location and down. With that large of a loan, you're plugging $700,000, $800,000, $1,000, depending on loan structure, towards principal every month. So you're saving $2,500 in your bank account. You're saving $1,000 in your mortgage. Jeb already pointed out that if you're saving that much money, you're making good money. You're getting taxed. We talk about entry-level buyers buying $250,000 homes that make $60,000. There is probably no tax advantage above and beyond the standard deduction, especially for a married couple. But in this situation, that big of a loan, you are absolutely going to get tax savings. Where you live and the local taxes, the state and local taxes there will come into play of how big that is, but you're probably going to get another $1,000, $1,500. And then you are going to get leveraged growth. Let's say that instead of the historical 5% growth, you're going to get 3% growth on that $600,000-$700,000 house. Say that's $20,000, another $1,500. It's far closer than you think it is. You are probably correct, but there's not a gap of $6,000 there between those two options. It's cheaper to rent. You will be able to save more. So my answer comes back to, what do you want to do? And how savvy are you at investing those funds? The better you are at investing the difference, the more it makes sense to continue renting. And then it also is dependent on you being happy being a renter and not a homeowner.
Yeah. I mean, there's some things that we can't answer there, but sometimes the numbers help sway that decision. So if you're still here, comment. Josh, we're going to do a rapid fire here in a minute. So I'm trying to save some of the softball questions, Josh, for the end. So let's here's
a comment that I just want to throw a quick response to. So Charles says, I'm buying my first home within the next 4 months using a VA loan, trying to learn as much now. Here's a shameless plug I'm throwing here in the comments. Charles, I do a live 8 out of every 12 weeks on Tuesdays. And I just posted there in the comments basically the playlist of them. So you can go back and watch the last 8 or 10. It's mortgage and real estate experts. We sit around and talk for an hour about the topics you need to know. If you're a veteran and you don't know what you're doing with that VA loan, lots of online companies, big call centers take advantage of veterans. Go there and educate yourself. You'll learn everything you need to know.
There you go. Let's see here. This is a question I can't speak to directly. But I'm going to go out on a limb and say no. It says, do you see people doing the 1% mortgage in Cali? In Southern California, it's not going to work for the most part. Could it in some places? Sure, but it's not common. You're going to have to go up to more central California for the price points to even make sense to be able to do the 1% and or north of like San Francisco, like up in the area, like where no one lives.
It's not California, Jeb. It's not California.
Yeah.
You go more than an hour north of the Bay Area. It's no longer California.
So for the most part, I think the answer is no, just because of where price points are. Could there be some? Yeah, not a majority by any means. All right, Josh. I promised I would talk about the property that I have on the market. So listed a property in Lakewood. Some of you guys came through the property. I would say on a 2-day showing. So the property was listed at 810. I didn't count, but I would say not on average, through 2 days, 3 hours each day, probably had 100 plus groups through, maybe 150. I don't know. It was a lot of people. It was always busy. There was only like a 2-minute span in that entire time where I was by myself. So a lot of people through. Ended up with 26 offers. With that, we had a lot of different things, a lot of different down payments, a lot of different people asking different things in the offer, way the offers were positioned, just different things. The reason I bring this up is because when the market was crazy, I did a video on this and I went through and told you guys, hey, this is what people are doing now. And the reason I did that, for one, to help you as a buyer become more competitive. You guys are always asking, what can I do to help my offer stand out? Well, I just redid that video using this example. I'm not going to plug all the stuff here, but it's going to be published next week. So it's going to be a good video, and it probably won't be published until next Friday. But I'm going to show you what people are doing in this market, the types of loans they're doing, the type of down payment they have, what they're asking for on contingencies, time frames, everything, just to give you an idea, if you're a buyer out there, how to compete. So hopefully you're going to find some value in that because it shows you, hey, this is 26 different people and what they did in order to try to get their offer accepted. There was one thing that one person did that helped them stand out. And that's a shameless plug because I'm not going to mention it other than you watching the video. So Josh, a little rapid fire here. Actually, we won't go rapid fire because we were a little late. We were delayed. So we got a little bit of time here to chat. If you're good with it for a couple minutes, just Wesley, you're from Lakewood, but you don't live in Lakewood, bro. Not anymore. Not anymore. This guy says invest in car rims, tires. I had new tires put in my car yesterday, or today rather. Man, I paid, tires are expensive, bro. I'm in the wrong business. I should just sell tires. I'm going to buy tires wholesale and sell them.
Well, I told you my tires have gone to the moon since I put them on my truck, and I've been looking at almost $500 a tire. So I'm not stoked about the.
And I realize you need tires. You need tires. You need to be safe in your car. But it's like one of those things. It's like going to the dentist. You get zero joy out of spending the money. It's like you just threw it away because you don't think of your tires when you drive. Whatever. Okay. Just went off on a tangent. Trish. How long would I have to wait to get a pre-approval mortgage if I get a new job? Same field, W-2.
No wait whatsoever. That's an easy one. Unless you have a significant gap that can't be explained, where you were fired and couldn't get another job, you're fine. Same line of work, you're W-2. You're not going from self-employed to employed to self-employed. You're not changing lines of work, job titles. You're going to be absolutely fine.
Living in Omaha says, what's the biggest mistake you see home buyers making in today's market? Well, if you were a subscriber of the Educated Home Buyer podcast, the YouTube channel, or you listen on Spotify or Apple or any other podcast platform, you would know last Tuesday, actually this Tuesday, yesterday, published the episode where we talk about mistakes people are making in the market, mistakes we've made. If you haven't listened to it, go listen to it, check it out. Another Spotify. I guess it helps. Who knew how much it helps? So if you guys are listening and you haven't done so, do that. It would be beneficial. For that, we will give you an extra 10 minutes of time here on the show, but you got to prove to us that you did it. I don't know how we do that. So, Josh, we'll just keep doing what we're doing here. All right. We're at 6:00. Let's just answer a couple that we had here, Josh. There were some good ones. Do you see any short sales in the future, Josh?
Any? Unlikely. It would be people that came in very late, middle of last year forward. Other than that, people have equity. So you would need either people coming in late and home prices dipping, or coming in late with a low down payment. Let's say you bought in January of this year with an FHA loan and you get transferred to the other coast and you have to sell it. That would be a situation where you wouldn't have enough equity to pay, both sets of realtors' commissions and closing costs. But you also, to get a lender to agree to that, you have to prove them that there's a hardship, and their best case scenario to get all their money is in doing the short sale for you. So not in the foreseeable future. And if you saw, I don't know if you saw this week, Jeb, Zillow came out saying they're projecting like 5% appreciation between now and the end of the year. You're on record as saying you think we'll see some flattening. The charts definitely show the market slowing the rest of the year, but they're projecting that's a big price increase for an elevated price in a market.
We are, but we can go back and say historically they haven't really been that accurate in some of their stuff. They've changed their,
they haven't been that far off.
They haven't been that far, but they do.
Can't be.
They change their number more often. They don't just throw a number out for the year. They reassess that thing like every 3 months. And that's fair. I mean, because data changes, things change. But so I wouldn't put too much weight to that. Buy when it's the right time in your life. Stop worrying about what Zillow thinks. How's that? This is a good question. Monica says, if my mortgage company is asking for an appraisal to get my PMI off, will that reassess my taxes? No, it will not. You are good to go. That doesn't go anywhere.
And not only when doing that for an MI, doing it for a refinance, an appraisal goes to your lender, never goes to the government. The government is going to assess your property independently on their own. An appraisal you have done will never impact your taxes.
There you go. SNN Media says, do you think buyers' remorse on housing is real? A friend of mine seems depressed after buying a house last year, and a family member is having a relationship issue after they bought a house. So buyer's remorse is absolutely real. But the two things you mentioned here could be, not necessarily dependent on buying a house, right? I've seen people have kids because they thought having a kid was going to fix the relationship. In some cases, people might buy a house because they think the house is going to be the solution to the problem. So I wouldn't say one is a result of another, especially when I don't know the couple or the situation. But to get back on the idea of buying a house, it absolutely can. Especially if you feel like you paid too much, or you can't afford the monthly payment, or now you're in a position where you'd like to move and you can't because you own a house. And yeah, for sure, those can be real problems. But how do you avoid them? That plan that we talk about, thinking a little bit further out in the future, thinking about where you think you'll be, where you plan to be, different life events. None of this stuff is, predictable. But some of it you can pay a little bit more attention to so that you're not putting yourself in a bad position. And that's really what it is. Not just jumping at the gun, deciding you want to buy a house and going out and doing it tomorrow. Figuring out, the things that are important to you, why they're important to you. If you have a spouse, what's important to them. Coming together and figuring out where you want to be and not sacrificing a location and other things kind of prevents that. So with that said, Josh, we're at 6:03. We're going to bell. We got 83 likes. We got 82% of the 93 people basically said, keep the show like it is. So next week we'll be back, hopefully without an internet issue.
Hopefully with a better internet connection.
Yeah. I mean, I was to the point, guys, where I had logged into my phone and I was about to do the live from my phone here. And what I will say is I was extremely surprised to come back in after being like off the grid, so to speak, from the internet, and see like 55 of you guys waiting for us to come back. So that says a lot about the community, says a lot about you guys, and the support and the loyalty. And honestly, I'm really grateful for that, because I walked into Josh's office. My door's still open here because so thank you. Thank you guys for sticking around. Thank you guys for asking questions. Thank you guys for getting us and allowing us to do what we do. Josh?
It's a crazy market. Educate yourself. Don't have buyer's remorse. Think it all the way through. Think about your life plan, life stage, where you're at, where you want to be, where you want to go. If you're going through a rent versus own analysis, get someone who can walk you all the way through it. As you saw in that extreme example of big monthly savings and a big increase in housing cost if they buy. It's not just as simple as it's cheaper to rent, but educate yourself, make the best decisions for yourself. Educate yourself, Jeb. Watch the Educated Homebuyer podcast every week and educate yourself.
Yeah. I mean, really, it's good information, guys. I mean, I even learned things in there. Sounds crazy. I really do. Because it provokes a lot of questions when go check it out. If you haven't liked and subscribed to this channel, please do that. I'm begging you, right? This is me begging. And go over to the other channel and do the same. So anyway, we'll be back next Wednesday with another action-packed episode of the Educated Homebuyer Live. Until then, adios.
Amigos.
Sometimes I have to prep, Jeff.